The stock market often appears as an intimidating wall of jargon and flashing numbers. Yet the entire system operates as a structured ecosystem built on specific physical and regulatory boundaries. This environment starts with the stock, a legal claim of ownership. While private companies keep their shares restricted to founders and specific investors, public companies list their shares on the open market. This allows anyone to buy common stock for voting rights, or preferred stock, which provides a priority claim on dividends. These shares are traded in specific marketplaces. The New York Stock Exchange is the most prominent historical example, serving as a central hub for corporate trading for over 2 centuries. The NASDAQ exchange offers a modern alternative, an electronic, tech-heavy marketplace, home to some of the world's largest software and hardware giants. Today, this entire process is monitored by the Securities and Exchange Commission. By enforcing strict transparency and rules, the SEC creates the baseline trust that allows money to move through the market. To participate, a retail investor uses a broker to execute trades using ticker symbols. These short codes, like AAPL for Apple or TSLA for Tesla, allow for the rapid movement of shares during official market hours. Now, the ease of these trades depends on market volume. High-volume stocks like Tesla offer deep liquidity, meaning you can buy or sell shares instantly without significantly moving the current price. This individual activity is aggregated into a universal scoreboard called an index. The S&P 500, for example, tracks the performance of 500 top companies. If your own portfolio earns a higher return than this benchmark, you have successfully outperformed the broader market. This chart shows how we calculate the total value of a business. To find the market capitalization, you multiply the current share price by the total number of shares available to the public. But valuation is only one part of the story. A company starts with gross revenue, which is the total income from sales. After subtracting operating costs, debt payments, and other liabilities, the remaining profit is the net income. By dividing that profit by the number of shares, we get earnings per share. This allows investors to use the P/E ratio, comparing the stock price to its earnings, to see if a company is trading at a fair value or if it is overhyped. How a company handles its cash defines its category. Growth stocks belong to companies that reinvest their free cash flow into rapid expansion, focusing on increasing their market share rather than paying investors. On the other hand, blue-chip stocks like Coca-Cola are considered stable and reliable. These established companies often return a portion of their profits to shareholders through regular dividend yields. Using these ratios to evaluate a business provides a clear view of its financial health, allowing you to ignore market noise and focus on the data. Investors reduce the risk of a single company failing by holding a mix of assets. Mutual funds provide this diversity by pooling money from many investors to buy a professionally managed collection of stocks and bonds. Alternatively, index funds and ETFs track an entire sector or index like the S&P 500. Because they are passive and don't require an active manager, they typically have much lower costs. Choosing where to hold these funds is just as important as the funds themselves. The Roth IRA is a specialized account designed to protect your investments from future taxes. With a Roth IRA, you contribute money that has already been taxed. In exchange, the government allows your investments to grow entirely tax-free, and your withdrawals in retirement are generally not taxed at all. Because passive funds eliminate high management fees and Roth accounts shield growth from the IRS, these structural choices are often more significant for wealth generation than trying to time the purchase of individual stocks. Beyond the numbers, the market moves on emotion. A bull market occurs during long periods of rising prices and investor confidence, while a bear market is defined by falling prices and widespread pessimism. To track this sentiment, investors watch the VIX, also known as the Fear Index. It measures expected volatility, acting as a warning signal when the market anticipates sharp price swings or potential crashes. To survive this volatility, many use dollar cost averaging. By investing a fixed amount of money every month, you automatically buy more shares when prices are low and fewer when they are high, smoothing out the cost of your portfolio over time. By combining proper asset allocation with a disciplined strategy like DCA, investors remove emotional panic from their decision-making. This transforms a market dip from a moment of fear into a calculated opportunity to buy. At the highest level, macro forces act as the gravity for all assets. High inflation reduces what your money can buy, while stagflation creates a difficult environment where prices rise even as the economy slows down. The Federal Reserve acts as the central banking authority tasked with managing these cycles. It influences the economy through monetary policy. By manipulating the money supply and adjusting interest rates, the Fed chairman can either encourage growth or intentionally slow the economy down to combat inflation, which directly impacts stock valuations. This works alongside fiscal policy, which is controlled by Congress. Through spending and taxation, the government can choose to inject capital into the economy or withdraw it to manage growth. Tracing this sequence from a single stock ticker up to the policy decisions of the Federal Reserve removes the mystery from Wall Street. With the mechanics of the system exposed, you can focus on building your financial future with confidence. Subscribe for more guides to mastering the market.